on to today's Market Movers with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Uriel, and we are a couple days ahead of the biggest week of earnings season, and that's Tech Week. We're looking at using NASDAQ weekly options to either hedge risk or perhaps even create additional exposure to these events. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
So on the 25th is Amazon and Google. Is that all we need to know, or do we need to see Apple as well on the 1st?
I'm a believer that Amazon actually does it all these days because it's not just a retail store anymore. It's also tech and everything that's kind of going on with the internet and some of the advertising and things. So to me, Amazon's really the bellwether of the economy that actually save earnings reports.
So are you saying because now it's reached such a scope that it actually gives us economic data on the country as well?
Yeah, it is. And given its size, too, as a $1 trillion company, I mean, it also does have a little bit of influence in the S&P 500 and other indexes.
I see what you're saying. I kind of think Google and Apple are important as well, too. Now, before we dive into our trade discussions, I'd like to point out, with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendation or advice. Price and movements are going to vary. When we priced this, it was trading 71.30 in the NASDAQ, but it's been all over the place today. Volatility's been amazing. Scott?
Yeah, it's been a busy day, and so the NASDAQ's probably moved about 50 points, and you just said that last line, Jim.
Right.
So, one thing that we do in Market Movers when we come into, I think, pricing these trades is we look at where options are priced effectively, because I like to come in with a bias, yes, but I also like to look at the charts and the prices and see, okay, what's costing what to put on. So today I found something that I think is relatively fair out there, and that's specifically, Jim, looking at buying the 7100 7050 put spread for 17 ticks. This trade expires October 26. It risks 340 to make a potential 660. The NQs, as you mentioned, are lying about 7130. Because if you just, not just being bearish here, but if you look at the charts, and then we had that downdraft a couple weeks ago, and guess what? The market rallied back up about 50%, the NQs did, of that downdraft, and has found resistance and coming down again. So I think that's back in play as far as another resumption of that downdraft. We've seen the rally. That's why I want the put spread.
I think in moments of kind of quasi-panic like this, I really like buying put spread, particularly because of the shape of the skew curve and that the puts you sell, the further out puts, you're going to get more bang for your buck. So I think that's good risk reward. I'm not this way. I'm looking at another way because I just think that things have taken it so hard in the stock market today and some of the other days this week. I think the potential for these tech names to report, and it could be a positive experience. So I'm looking at buying the week for NASDAQ, the 7350, 7400 call spread for 11 ticks. So I'm paying less than you paid. It also expires October 26, risks 220 to make 780. Currently, the underlying 7130. I know it's not your direction, but thoughts?
It's not my direction. Yes.
Okay, fair enough.
There you go. That's the analysis you're looking for, right?
Yeah.
It's a good risk-reward proposition, that's for sure. It's the wrong direction, I think. But your point's well taken. I mean, look, in days like this, when the market gets absolutely flushed, then you're going to see call spreads get a little bit cheaper, and that's sometimes when you got to go contrarian and put them on.
Okay, independent of the way the market's going to move after these earnings reports, do you think they're going to report good earnings? Good solid earnings, and I know they could get hit after that. I've seen it happen.
You've seen it happen. In fact, recently, case in point, two of them, Netflix and Adobe did the same thing. So yes, they could have good earnings. I think they will. How the market treats them is anybody's guess.
Thanks for joining us on Market Movers. I'm Jim Uriel, where we're helping make you a better trader.
Check out businessfirstam.com to find out where to see our entire show. And don't forget to like, follow, and share Business First AM.